Chapter 5, Bank Reconciliation Statement. So, in Chapter 4, you have learned that the business organization keeps a record of their cash and bank transactions in a cash book. The cash book also serves the purpose of both the cash account and bank account and shows the balances of both account at the end of the period. Once the cash book has been balanced, it is usual to check its detail with the record of the firm's bank transaction as recorded by the bank, and to enable this check, the cashier needs to ensure that the cash book is completely up to date and a recent bank statement has been obtained from the bank. Bank statement, in the sense, it is also called a bank passbook. A bank statement or a bank passbook is a copy of bank account as shown by the bank records. This enables the bank customers to check their funds in the bank regularly and update their own records of transactions that they have occurred. The amount of balance shown in the passbook or the bank statement must tally with the balance as shown in the cash book, but in practice these are usually found to be different. Hence, we have to ascertain the causes for such difference. It will be observed that a bank statement or passbook shows all deposits in credit column and withdrawals in the debit column. Thus, if deposits exceed withdrawals, it shows a credit balance, and if withdrawal exceeds deposits, it shows a debit balance, which means overdraft. And here, need for reconciliation. It is generally experienced that when a comparison is made between the bank balance as shown in the firm's cash book and two balances do not tally. So, the mean here is, when bank reconciliation statement is prepared, we are going to compare the two books. Okay, so one is the passbook which is prepared by the bank and another is the cash book which is prepared by the organization. Both have to be tallied here, and again the next need here is, hence we have to first ascertain the causes of difference thereof and then reflect them in a statement called bank reconciliation statement to reconcile the two balance, which means to tally the two balances of cash book as well as the passbook which is prepared by the bank. In order to prepare a bank reconciliation statement, we need to have a bank balances as per the cash book and a bank statement as on the particular date along with details of both the books. Now, if the two balances differ, the entries in both the books are compared and the items on accounts of which difference has been arisen are ascertained with the respective amounts involved so that the bank reconciliation statement may be prepared. So, now let us see the format of bank reconciliation statement, where we will be having particulars and amount. So, where we will be having balance as per the passbook, then we will be having additions where we are going to add the check issued but not presented and interest credited by bank, which means here whatever check we are going to present in the bank, that should be added. Again, the interest which is credited by the bank, that should be added to the cash balance. And what should be deducted here? We are going to deduct is checks deposited but not credited by bank. What check we have deposited into the bank, if they are not credited, if they are not credited to our account, that should be deducted. Again, bank charges not recorded in the cash book. So, bank charges which were not recorded in the cash book, that charges we are going to deduct from the balance what we have, and the leftover balance will be balance as per the passbook. Then we are going to see here the difference between the cash book and the bank passbook is caused by. So, what are the reasons or what are the causes where we are going to find the difference between the cash book as well as the passbook? So, let us say the difference here. The first one we have is timing difference on recording of the transactions. So, it is what? Timing difference on recording of the transactions and errors made by the business or by the bank. So, coming to the first point, timing difference. When a business compares the balance of its cash book with the balance shown by the bank passbook, there is often a difference which is caused by the time gap in recording the transactions relating either to the payments or receipts. The factor affecting time gap includes check issued by the bank but not yet presented for payment. So, here the check is issued by the bank but it is not presented for the payment. So, this might be the reason for the difference between cash book and bank book. And let us see the following differences what we have. Check paid into the bank but not yet collected. Check paid into the bank and not yet collected. Then again, direct deposits made by the bank on behalf of the customer. If anything which is directly deposited or if it is directly debited by the bank, then it is not known to the organization, then the difference occurs here. Then again, amount directly deposited in the bank account. So, if any amount is directly deposited into the bank account without intimating the firm, then the difference will be occurred. Again, interest and dividends collected by the bank. So, whatever interest or dividend we are supposed to get, if they directly collected by the bank, at that time these entries will not incur in the cash book, that we have to enter here. Then direct payments made by the bank on behalf of the customers. If any payment have to be made, it is made directly by the bank, then again that is not entered in the passbook. Then again, checks deposited or bills discounted or dishonored, at that time we are going to incur the differences. Let us take one small example here. If a particular person or if a particular customer is purchasing a vehicle on installment, which is on EMI, so easy monthly installments. So, what happens here, the customer will be having his own passbook. Okay, so now in that passbook the entries will be made only when this person is going to provide that book in the bank. So, now according to the customer what balance he has, that will be in the passbook. So, now if any installments is paid directly by the bank, it will be appearing only in the books of the bank, not in the books of the customer. So, same here, when coming to the organization, they will be having a cash book and bank will be having a passbook. If anything payments which is made on behalf of the company by the bank, that entries will be made only in the bank passbook, not in the cash book. So, now to remove this difference, we are going to prepare a bank reconciliation statement. And let us take the one more point what we had is checks issued by bank but not yet presented for payment. So, what is this concept here is, when checks are issued by the firm to the supplier or creditor of the firm, these are immediately entered on the credit side of the cash book. However, the receiving party may not present the check to the bank for payment immediately. What it means here is, what payment we are supposed to make for the supplier or the creditor, we are giving a check to him, but that person is not depositing the check or he is not presenting the check immediately in the bank. But when we are giving the check, at that time itself we are going to show in the credit side of the cash account that the payment has been made to the supplier. So, immediately we are going to reduce the cash in the cash book, but coming to the bank book, until that particular check has been presented in the bank, the amount will not be deducted. So, here it may cause the difference. Then the bank will debit the firm's account only when these checks are actually paid by the bank. Hence, there is a time gap between the issue of check and its presentation to the bank, which may cause the difference between two balances. And another point we have, checks paid in the bank but not yet collected. When firm receives checks from its customers, which means debtors, they are immediately recorded in the debit side of the cash book. This increases the bank balance as per the cash book. However, the bank credits the customer account only when the amount of check are actually realized. So, the clearing of check generally take few days, especially in case of outstation checks or whenever the check are paid in at a bank branch other than the one at which the account of the firm is maintained. This leads to a cause of difference between the bank balance shown by the cash book and the balance shown by the bank passbook. And the one more concept we have, direct debits made by the bank on behalf of the customer. Sometimes the bank deducts amount for the various services from the account without the firm's knowledge. The firm comes to know about it only when the bank statement arises. Example for such deduction include check collection charges, incidental charges, interest on bank overdraft, unpaid checks deducted by the bank, that is stopped or bounced, etc. As a result, the balance as per passbook will less than the balance as per the cash book. And then we have amounts directly deposited in the bank account. So there are instances when debtors or customers directly deposit money into the firm's bank account, but the firm does not receive the intimation from any source till it receives the bank statement. In this case, the bank records the receipt in the firm's account at the bank, but the same is not recorded in the firm's cash book. As a result, the balance shown in the bank passbook will be more than the balance shown in the firm's cash book. And then we have interest and dividends collected by the bank. When the bank collects interest and dividends on behalf of the customer, then these are immediately credited to the customer's account, but the firm will know about these transactions and record the same in the cash book only when it receives a bank statement. Till then, the balance as per the cash book and passbook will differ. And then we have direct payments made by bank on behalf of the customer. Sometimes the customers are given standing instructions to the bank to make some payments regularly on stated days to the third parties. For example, telephone bill, insurance premium, rent, taxes, etc. are directly paid by the bank on behalf of the customer and debited to the account. As a result, the balance as per the bank passbook will be less than one shown in the cash book. Then again we have checks deposited or bills discounted or dishonored. If a check is deposited by a firm, is dishonored, or a bill of exchange drawn by the business firm is discounted with the bank, is dishonored on the date of maturity. The same is debited on customer's account by the bank. As this information is not available to the firm immediately, there will be no entry in the firm's cash book regarding the above item. This will be known to the firm when it receives a statement from the bank. As a result, the balance as per the passbook would be less than the balance as per the cash book. So here, difference caused by errors. So when coming to the difference caused by errors, errors committed in recording transaction by the firm and errors committed in recording the transaction by bank. So here the error can be from both the side. It can be by the bank when recording the transaction in the bank passbook, or it can be by the firm while recording the transaction in the firm's cash book. So now coming to the first point, errors committed in recording transaction by the firm. Omission or wrong recording of transaction relating to check issued or check deposited and wrong totaling, etc. committed by the firm while recording entries in the cash book causes difference between the cash book and the passbook. And the second point, we have errors committed in recording transactions by the bank. Omission or wrong recording of transactions relating to check deposited and wrong totaling, etc. committed by the bank while posting entries in the passbook, and it causes difference between passbook and cash book balance. So here the overall concept what we discuss here is regarding the difference. What it means here, whenever the payments are made or whenever the charges are charged by the bank, immediately the bank is going to make the changes in the bank passbook, but the firm will be knowing about that only when they are going to receive the bank statement. So because of this, both the side totals what we have when coming to the bank passbook and when coming to the cash book, the total will be differing here. So now whatever adjustments were made by the bank, the firm is going to know only when the bank statement they are going to receive. So this difference is what we are going to equalize by preparing the bank reconciliation statement. So now let us take the concept preparation of bank reconciliation statement. After identifying the causes of difference, the reconciliation statement may be done in the following two ways. So first one is preparation of bank reconciliation statement without adjusting cash book balance. So let me repeat once again. By one way we can prepare the bank reconciliation statement, which is preparation of bank reconciliation statement without adjusting cash book balance. And the second way we have is preparation of bank reconciliation statement after adjusting cash book balance. Coming to the first way of preparing bank reconciliation statement. So here preparation of bank reconciliation statement without adjusting the cash book balance. So here to prepare bank reconciliation statement under this approach, the balance as per cash book or as per the passbook is the starting item. The debit balance as per the cash book means the balance of deposits held at the bank. Such a balance will be a credit balance as per the passbook. Such a balance exists when the deposit made by the firm are more than its withdrawals. It indicates that favorable balance as per the cash book or favorable balance as per the passbook. On the other hand, the credit balance as per the passbook the credit balance as per the cash book indicates bank overdraft. In other words, the excess amount withdrawn over the amount deposited in the bank, it is also known as unfavorable balance as per the cash book or unfavorable balance as per the passbook. We may have four different situations while preparing the bank reconciliation statements. These are when debit balance, favorable balance as per the cash book is given and balance as per passbook is to be ascertained. And the second condition is when credit balance, a favorable balance as per passbook is given and balance as per the cash book is to be ascertained. And when coming to the third case, when credit balance as per the passbook, which is unfavorable balance or overdraft balance, is given and balance as per the passbook has to be ascertained. Case 4, when debit balance as per the passbook, which is unfavorable balance and overdraft balance, is given and the cash book balance as per is to ascertained. So here dealing with unfavorable balance. So let us take first concept first, dealing with favorable balances. The following steps may be initiated to prepare the bank reconciliation statement. So step 1 will be the date on which the statement is prepared is written at the top as part of the heading. So here in the heading first we are going to write the date when the statement is written, and the number 2 is the first item in the statement is generally the balance as shown by the cash book, and alternatively the starting point can also be the balance as per the passbook. So both can be done here. The starting point can be the balance of the cash book first or the balance of the passbook first. And step 3 is the checks deposited but not yet collected are deducted. So whatever checks we have deposited and amount is not being collected, that have to be deducted. And the fourth step we have all the checks issued but not yet presented for payment, amounts directly deposited in the bank are added. So any check we have already issued and it has been added, that should be considered here and the amount will be added. And step 5 we have all the items of charges such as interest on overdraft, payment by bank on standing instructions, and debited by the bank in the passbook but not yet entered in the cash book, and bills and checks dishonored etc. are deducted. So any payment which is made by the bank on behalf of the firm, that amounts we are going to deduct here. And the sixth step we have is all the credit given by the bank such as interest on dividends collected etc. and direct deposits in the banks are added. So anything deposited in the bank will be added here in the cash book. Then the seventh adjustment we have is the seventh step. Adjustment for errors are made according to the principle of rectification of errors. So for this adjustments, or when coming to the errors, we are going to follow the principle called rectification of errors. And step 8 is, now the net balance shown by the statement should be same as shown by the passbook. It may be noted that treatment of all the items shall be the reverse of the above if we adjust passbook balances as the starting point.